Imagine for a moment that every single metric you use to measure wealth, your bank account balance, the value displayed on your brokerage app, the supposed equity in your house, suddenly loses 90% of its real purchasing power overnight. Not through some slow, grinding recession, but through a violent, catastrophic systemic failure. This is not fear-mongering. This is the grim statistical inevitability that is currently being ignored by the vast majority of institutional and retail investors across the globe. We are standing at a precipice, staring down into the abyss of a global financial reset, an event so profound it will redefine the very concept of money and wealth preservation for a generation. The crucial question, the only question that truly matters in this environment, is simple. When the crash comes, when the leveraged debt structure finally collapses under its own weight, what few specific assets will actually hold their value, or, better yet, increase their purchasing power dramatically? The man who has spent the last 5 decades studying these cycles, who famously sounded the alarm before the dot-com bubble burst and, critically, months before the 2008 financial crisis, the legendary investor and financial titan Eric Sprott, is not just issuing a warning, he is issuing a precise survival manual. His message is clear, urgent, and radically contrarian. In the coming liquidity crunch and subsequent monetary debasement, only a tiny, specific selection of assets that defy the modern fractional reserve and debt-based architecture, will survive. Everything else, the bonds, the conventional equities, and most forms of paper wealth, he argues, is doomed to collapse into irrelevance. Let us establish the foundation of this impending disaster, because without understanding the sickness, we cannot appreciate the cure Sprott is prescribing. We are witnessing the terminal stage of a gargantuan global debt supercycle, characterized by central banks that have abandoned all pretense of sound monetary policy. Since 2008, and accelerating dramatically since 2020, governments and central banks have engaged in what can only be described as a quantitative insanity, printing trillions upon trillions of unbacked currency units into existence. This mass creation of credit has artificially inflated nearly every financial asset class, stocks, real estate, junk bonds, while simultaneously stealthily destroying the purchasing power of the underlying currency itself. This process is not benign inflation. It is outright monetary debasement. When the Federal Reserve and other major central banks declared their willingness to print whatever it takes, they signed the death warrant for the existing fiat system. The immediate conflict we face is between 2 catastrophic choices. The Fed must either continue raising interest rates to fight raging price inflation, thereby guaranteeing the immediate collapse of the highly leveraged debt and asset markets, or they must capitulate, reverse course, and begin printing money again, thereby guaranteeing hyperinflation and the total destruction of the dollar's function as a store of value. Both paths lead to the same destination for the average portfolio: mass destruction of paper wealth. The core vulnerability, the Achilles heel of the entire Western financial apparatus, lies in counterparty risk. Almost everything you own is a promise. A bond is the government's promise to pay. A bank deposit is the bank's promise to return your cash. A conventional stock is a share in a leveraged corporate entity. When stress hits the system, when liquidity freezes and institutions fail, these promises are revealed for what they often are: worthless paper obligations. Sprott's genius lies in recognizing that the survivor assets must fundamentally remove this counterparty risk from the equation. They must be assets that are themselves the store of value, not an entity's promise to provide value later. And this leads us to a critical realization. Many people, attempting to hedge against this catastrophe, have shifted into popular alternative assets like specific cryptocurrencies, real estate investment trusts, or highly leveraged commodities. While some of these might perform well in the short term, they often carry hidden counterparty risks or liquidity issues that Sprott believes will be fatal during the actual crash. The solution, according to him, is far more deeply rooted in historical, tangible reality than modern financial engineering. If you are beginning to feel the profound weight of this impending reality, you are not alone. This is the moment for radical repositioning, not just minor portfolio adjustments. If you are serious about protecting your wealth and ensuring your family's financial future, take a moment right now and smash that subscribe button and hit the notification bell. We are breaking down the specific mechanisms of financial survival that the mainstream media refuses to acknowledge, and you do not want to miss a single step. The key to surviving this impending systemic shock, as Sprott meticulously outlines, is shifting your focus from return on investment to return of capital. Let us dissect the debt crisis further. The global debt-to-GDP ratio is at historic highs. Governments have used low, effectively zero interest rates for over a decade to finance colossal deficits. Now, as inflation forces rates higher, the carrying cost of this debt is becoming unsustainable. We are nearing the point where tax revenues are not sufficient to cover mandatory entitlement spending plus the interest payments on the outstanding debt. When the world realizes that the largest debtors, the US, Europe, Japan, literally cannot afford their own debt payments, confidence in government bonds, the bedrock of the financial system, will completely shatter. This is where the real devastation begins. When the bond market breaks, the cascade effect is immediate and brutal. Banks holding massive reserves of government bonds see their assets crater. Liquidity dries up. The derivatives market, an enormous shadow web of leverage that dwarfs the underlying physical economy, unravels instantly. This is the mechanism by which your paper wealth disappears. It won't be a slow erosion. It will be a sudden, violent repricing based on the loss of faith in the underlying monetary unit. Eric Sprott is adamant. The assets that will survive this conflagration must possess three non-negotiable characteristics. First, zero counterparty risk. As we discussed, they cannot be promises. They must be physical, tangible items that exist outside of the banking system's ledger. Your ownership must be absolute, requiring no government or bank guarantee to validate it. Second, high liquidity and global acceptance. While raw land or rare art might be tangible, they are illiquid and difficult to monetize quickly in a crisis. The surviving assets must be universally accepted and easily tradable, maintaining their value across borders and jurisdictions. Third, and perhaps most crucially, they must be undermined by central bank intervention. This is the pattern interrupt. Most assets are inflated by central bank money printing. The surviving assets, by contrast, must be those that central banks and governments have actively suppressed or ignored because their existence exposes the fundamental fragility of the fiat system. This brings us to the ultimate criteria for survival, the precise filter Sprott uses to identify the few assets worth holding. They must represent the ultimate expression of sound money principles in a world gone mad with credit. They are not merely hedges, they are the antithesis of the current debt system. We have now established the battlefield, a debt-fueled collapse leading to a catastrophic loss of confidence in fiat currency. We have defined the necessary characteristics of the survivor assets: tangibility, liquidity, and freedom from third-party promises. The stage is set for the reveal. The question now is, what specific actionable vehicles fit these extremely rigorous criteria? What are the precise physical assets and the unique equity vehicles tied to them that Eric Sprott is staking his entire legacy on as the only true lifeboat in the coming storm? This is the knowledge that separates financial survival from absolute catastrophe. Do not wait for the inevitable market turmoil to realize you needed this information yesterday. Ensure you are locked in for the next crucial part of this survival manual. Click that like button and make sure you are subscribed. This is the difference between watching your life savings vanish and positioning yourself to not just survive, but potentially thrive during the greatest financial transfer of wealth in modern history. We stand now at the precipice, having meticulously traced the historical fault lines and structural weaknesses inherent in the global financial architecture, a structure Eric Sprott argues is designed not for stability, but for eventual collapse. The debt mountain, the politicization of central banks, the erosion of real purchasing power. These are not theoretical risks anymore. They are the active decay of the system we rely upon. The crucial question we must now answer, the core thesis of Sprott's life work, is this: when the systemic reset occurs, when the waves of debt vaporization cascade across the globe, what tiny lifeboat, what single, foundational asset will remain viable? The conflict we face is deeply insidious, rooted in the very nature of modern finance. We are taught to trust claims, promises, and digital ledger entries. We measure our wealth in units that are infinitely reproducible by governmental decree. But the moment confidence evaporates, and it will, those promises become worthless, vaporized by the very speed of the electronic markets that created them. Sprott's core warning is simple. If you cannot hold it, if it is a liability on someone else's balance sheet, you do not own it. You merely possess a claim, and in a bankruptcy, claims are often dismissed or settled for pennies on the dollar. This brings us directly to the open loop we must close, the counterparty risk. Imagine a scenario where the major brokerage houses are freezing assets, fearing insolvency. Your paper ETF, your digital crypto held on an exchange, your bond portfolio. These are all subject to the solvency of the institution that manages them. The moment the music stops, your access is severed, perhaps permanently. The conflict is the illusion of liquidity versus the reality of ownership. For too long, the financial establishment has successfully marginalized the true, non-fiat, non-political assets, labeling them as relics of a bygone era. They mock those who store wealth in tangible form because those assets cannot be manipulated, leased, or rehypothecated to feed the debt machine. This is where the pattern interrupt hits. Sprott fundamentally rejects the entire concept of a diversified portfolio built on fiat instruments. He sees most mainstream assets, stocks, bonds, real estate, highly leveraged, even most ETFs, as merely different flavors of debt or fiat promises. His survival thesis narrows down the field of viable assets to an almost fanatical degree. It is not about diversifying risk. It is about eliminating counterparty risk entirely and concentrating capital into what is demonstrably, historically, and scientifically scarce. After decades of study, trading, and observing monetary crises globally, Sprott's definitive conclusion is uncompromising. The only assets that will survive the next crash and retain or massively increase their purchasing power are physical gold and physical silver. But even this statement requires critical nuance. Simply owning gold on paper through a traditional bank or ETF, where the underlying metal is leased out or held in a fractional reserve system, defeats the purpose. The survival mechanism requires physical possession or explicit verified allocated storage outside the banking system's immediate grasp. However, Sprott's strategy for exponential returns moves beyond simple bullion storage. While physical gold is the ultimate insurance policy, the bedrock of preservation, it is unlikely to generate the life-altering returns necessary to truly thrive in a post-crash world. This brings us to his leveraged strategy, quality mining equities. This is the pivotal point where preservation meets aggressive wealth accumulation. We must understand the arithmetic of scarcity. Gold currently trades at a historically high but still relatively suppressed level when measured against global debt or M3 money supply. Silver is the truly anomalous asset. The gold-to-silver ratio remains elevated, historically closer to 15:1 or 20:1, currently much higher, indicating that silver is profoundly undervalued relative to its monetary cousin, and crucially, relative to its accelerating industrial demand. Silver is being consumed globally in industrial applications, solar, medical, electronics, at an ever-increasing pace. And unlike gold, which is mostly stored, consumed silver is destroyed or uneconomically recycled. We are rapidly moving toward a critical supply deficit for silver. Sprott's trade is leveraged exposure to this inevitable price explosion through the miners. Why miners, and not just the physical metal? When the price of gold or silver doubles, the profit margins of a quality, low-cost mining operation do not just double, they may quintuple or more. This is the power of operating leverage. A miner has fixed costs, labor, energy, machinery. If a miner extracts an ounce of gold at a cost of $1,200 and the market price is $2,000, their profit is $800. If the market price jumps to $4,000, their profit per ounce jumps to $2,800. That is a 350% profit increase on a 100% price move. This leveraged magnification, where the return on the equity vastly outstrips the return on the underlying commodity, is the key to Sprott's philosophy for survival and prosperity. To execute this strategy successfully, one must be extremely discerning about the miners selected. Sprott insists on specific criteria that eliminate the common risks associated with the sector. 1. Jurisdiction. The company must operate in politically stable, mining-friendly locales, e.g., Canada, Australia, specific areas of the U.S. Avoid geopolitical hotspots where assets can be nationalized overnight. 2. Balance sheet. Strength. Low debt is paramount. In a liquidity crunch, highly leveraged companies fail, regardless of the spot price of their metal. 3. Discovery potential and proven reserves. They must either be expanding their known reserves significantly or demonstrating high-grade discoveries. This ensures their assets are truly in the ground and not reliant on constantly raising capital to finance shaky exploration. In the final phase of the monetary collapse, the hyperinflationary period that precedes the reset, mining equities, particularly those focused on silver, due to its dual monetary-industrial role, become the ultimate refuge. They represent real, tangible assets, the ground, that are generating cash flow in a currency that is rapidly losing value. They are one of the few places capital can hide where it retains intrinsic value independent of central bank manipulation. The central thesis of the crash survival plan is thus completed. We exit the financial matrix built on debt and paper promises and re-enter the realm of physical reality. We hold physical bullion as the absolute foundation of wealth preservation, and we utilize quality mining equities as the leveraged vehicle to ensure our capital not only survives the crash but accelerates through the resultant hyperinflationary environment. The final closure of the tension is the realization that the window for preparation is rapidly closing. Central banks are loading up on gold precisely because they understand the game is ending. Their accumulation is the strongest confirmation signal we could ever ask for that fiat currency's time is limited. They know that when the faith is gone, the only thing the people will accept in trade, the only things that will function as money, are those items that require labor, energy, and scarcity to produce, the metals. This is not just a financial strategy. It is a fundamental philosophical shift. It requires rejecting the comfort of mainstream media narratives and accepting the harsh reality that governments and central banks are trapped in a debt spiral from which there is no easy escape. The only way out is through a massive devaluation of the currency, and the only protection against that devaluation is the ownership of assets whose supply cannot be artificially inflated. We are transitioning from an era defined by promises to an era defined by tangibility. Eric Sprott is not offering investment advice for a normal market. He is offering a blueprint for monetary survival. His message is a stark, urgent call to action. Review every asset you hold. If its value is dependent on the continuation of the current banking structure or the solvency of the counterparty, it is at risk. The time for intellectual debate is over. The time for decisive, concentrated action is now. Don't let this comprehensive analysis simply fade into the feed. This information holds the potential to insulate your family's financial future from systemic shock. Review your portfolio tonight, applying Sprott's filter. Does this asset carry counterparty risk? If the answer is yes, you know the necessary steps. Take the next critical step and join our community dedicated to genuine financial resilience. Smash that subscribe button right now to ensure you don't miss the next critical update, and please share this specific episode with at least 3 friends or family members who you know are still relying on paper promises. Your ability to thrive in the coming chaos depends entirely on the choices you make today, before the market chaos begins. Act decisively, secure the physical, own the means of extraction. That is Sprott's final, definitive mandate.